Hello, I am very pleased to share with you some of our views of the economic environment. In this short video, I would like to concentrate on our long-term scenario and its implications for investment. Over the past few years, global economies have gone through a major transition. But today, the economic landscape is again changing. So what will be its main feature over the next 5 to 10 years? If we had to mention just one theme, it would be that of lower long-term global potential growth. Why? First, deleveraging. In the US and in Europe, private debt buildups boosted growth before 2008 and eventually triggered the global financial crisis. Since then, the deleveraging process has weighed on growth, and given the still elevated total debt levels, this will continue to be the case for some time. Second, productivity and demography. Indeed, GDP growth is made up of two components. The growth in GDP per worker, which is a productivity component, and the growth in the number of workers, which is a demographic component. Regarding demography, populations are aging, and according to the United Nations, working age population ratios will keep falling until the end of the century. Moreover, the growth in the world population will also decline towards 0% in the same period. So demographic trends will not be a support to growth. The second component of growth, productivity, is far more difficult to forecast. What we know for a fact is that since the 1980s, global productivity has gradually weakened in advanced economies. So what should we expect in the years to come? We do not pretend to be able to give a definite answer, but several factors point towards continued, subdued productivity growth. First, the downtrend we observe mostly stems from structural factors which tend to last. Second, the impact of the IT revolution from the 80s is fading. And third, taking the long view, a moderate productivity growth in the order of 1 to 2% would not be abnormal and simply be back at more sustainable levels. So all in all, deleveraging and demography clearly plead for lower long-term potential growth, while productivity is not strong enough to offset their impact. What are the consequences of lower long-term potential growth for investment? First, the output gap, which is the difference between realized growth and potential growth, is not as big as it seems. For example, in the US, the economy might be close to potential and the zero interest rate policy should end soon. Second, lower long-term potential growth implies lower equilibrium levels for yields at the long end of the curve, which in turn drives investors' search for yields and leads to structurally higher financial assets prices. And finally, lower yields lead to higher bouts of volatility and periods when correlation between equities and bonds is higher. This requires tactical skills, appropriate hedges, and the need to diversify portfolio into alternative sources of returns like hedge funds, asset-backed securities, or real assets. I thank you very much for your attention and remain at your disposal should you have any questions.